Good afternoon, or good evening, or good morning, depending on where you are in the world. And welcome to the first F8 question and answer or mentoring session. We have finally managed to reach the halfway point on the F8 course. So now is a useful moment for us to review what we've seen so far, in particular the big areas that are likely to have an impact on the 3 long questions on your exam. So, we've got to the beginning of internal controls, which is chapter number 4, and that means that we have so far seen 2 of the 3 big core areas, although one of them only in introduction. And we've also seen one of the more important side issues, which can also have a potential impact on the long questions, in terms of not just the knowledge that you need, but how you express that knowledge on exam day. Since we're reviewing, we're not going to do the review in the order of what we've studied so far. We're going to do it in order of priority. So let's begin by having a look at the first big core topic that we looked at. Audit risk and response. So, you recall that this question is typically worth 10 or 12 marks, and it is entirely practical. The only reason you need to have any knowledge for this at all is to understand what audit risk means, and to understand the types of response that you have available to you. But knowing those, to be honest, will never earn you that many marks. It's about, can you apply that understanding to a practical situation? So, a reminder that audit risk is the risk of material misstatement. In other words, the risk the financial statements are wrong and the risk that the audit work fails to detect those mistakes in the accounts. So audit risk is the combination of those 2 effects. The more likely it is that there are mistakes in the accounts, increases the risk that they're still there after the audit. And the worse the auditors are at spotting mistakes means the bigger the risk that any mistake could still be there after the audit, even if there aren't that many. So both are important contributors to audit risk overall. And if you understand that, explaining audit risks shouldn't be too difficult. Because when you are explaining a risk of material misstatement, since you are talking about why you think the financial statements might be wrong, you need to tell me which financial statement item or items you think are at risk, do you think they're at risk of being understated or overstated? And if you're not sure, say under or over. And it's not just numbers, by the way, which can be too high or too low, so overstated or understated. It's also disclosure items, and I'll show you an example or 2 of this in a minute. And you need to try to tell us why you think that risk exists. And that will probably involve mentioning the relevant IAS or IFRS rules and then applying it to whatever the story says. So a good risk of material misstatement within an audit risk answer will say things like this. Which financial statement item, I don't know, inventory, which way round, is at risk of overstatement, and then you explain why. Relevant rules, IAS 2 requires it to be valued at lower of cost, or NRV, company has some very old items whose NRV might be lower than cost in order to sell them. So notice the components of the explanation. Where in the accounts is the potential problem? Try and say which way round, over or under, and then use the story to generate an explanation. If, on the other hand, you are explaining a detection risk, it tends to be rather simpler because you don't have to talk about any accounting rules. Again, it's helpful if you can say which financial statement item. But if you can't detect the mistake, you're not going to know if it's over or under, are you? So here, a typical explanation might say something like, work in progress is complicated. So if audit staff lack experience in this industry, they might find it hard to know if WIP is valued properly. So there's a couple of potential examples of audit risk. And as I told you during the actual tuition classes themselves, most of the audit risks in an F8 question will be these. So get into the habit of saying the accounts might be wrong in this place here, and this is how they might be wrong, too high or too low, and practice the explanations, both in your head, if you don't have a pen to hand, but also, especially as we get closer to exam day, you need to start practicing explaining these and writing them down. The more you've done that in advance, the easier and more fluent you'll be on exam day. Responses to audit risk. Well, we noticed that these tended to come in a variety of basic flavours, didn't we? Sometimes the response is to name a specific test. So with the old items of inventory, I might be tempted to, I don't know, ask the directors what they're planning to do to sell those items, or do they have plans just to throw them away? I might look after the year end, because don't forget you do the main audit work after the year is finished. I might go back after the year end and see the items that existed at the year end and see if they have sold them yet, and if so, what price they managed to achieve. And those are specific tests. Sometimes our response to a risk is to put specific people on the audit team. If work in progress is complicated, maybe you need to find an industry expert to help out at the year-end stocktake, for example. Sometimes it's about the timing of the audit work. So, for example, if you are under time pressure on an audit, that creates detection risk because there's the risk that you don't spot mistakes due to lack of time. Response, start the audit work earlier. Try to arrange with the client that your staff can work during the weekends on the audit and not just Monday to Friday. Make sure the client's aware they'll have to pay overtime for this, of course. Now, I don't want to go back through every last detail, but those are the key things to understand about answering audit risk questions. That's all you need to know. All you've got to do now is practice. Towards the end of our last tuition class earlier this week, we started to look at the second core area as well. Now we've only started to look at this, but since we've looked at it, we may as well use the opportunity to review it as well. This is internal controls. And as I think I suggested earlier in the week on Monday night, there are 3 key skills that you need on the exam for this part of the course. And the difficulty is they all have the word control in them. Control objectives, control procedures, and tests of control. So if you knock the word control out of this, the key is, can you identify the difference between an objective, a procedure, and a test? And that involves understanding it, because if you understand it, it's not difficult. And then, of course, as with the previous thing, it involves practice. Control objectives are what the company wants to achieve. So that could include things like only accept goods in if they are good quality. So that's looking at the purchasing side of the business. It could be only pay staff for the hours they worked, just to give a couple of examples. Control procedures are the things companies do to try to achieve the objectives. So if you only want to accept good quality goods through your warehouse door, the procedure's pretty obvious, isn't it? The company should be inspecting a sample from each delivery for any potential quality issues, damage, etc. Now ideally, of course, that should be done before the goods are accepted. Sometimes though, when things are delivered, the driver can't hang around, so you have to agree with your supplier that you've got, 24 hours, 48 hours to identify any potential problems. Only pay staff for the hours they worked. Well, you need to know what hours they worked then. How about getting staff to clock in and clock out? Tests of control are what the auditor does to check whether the procedures in the middle column over there are operating properly. So how do you know that goods are being inspected for quality when they arrive? When we do tests of control, there's a little list we'll see more than once on this course of 5 types of audit test, A, E, I, O, U. And in terms of tests of control, it's the 3 in the middle, E-I-O. Remember, Old MacDonald had a farm, E-I-E-I-O. And if you've never heard about Old MacDonald, look him up on YouTube or something. So, E is enquire, ask someone, I is inspect, for evidence that some check has happened, and O is observe something happen. I think I'd be tempted to go and stand by the warehouse door, watch a delivery come in, and observe if they do indeed check for quality. But this is not the only solution to the question. After a quality check is done, surely the person at the company who did it would take a pen and write on the goods received note, initials, I've checked these for quality. So another way to test if it's happening is inspect the goods received notes for evidence of a signature. Get staff to clock in and clock out is what this company is doing. How do you know the staff clock in and clock out? Well, how about looking at the cards? Again, I could have gone for observe again and been boring and say if people all arrive in the morning and leave at 5 or 6 o'clock, you know when to go and watch, don't you? Easy one to observe. Ask the staff. Enquire. So there we go. That is internal controls. Objectives, procedures, tests. And as I said on Monday, when you've got all three of them there next to each other and you can see the difference between them and how they fit, it makes life a lot easier. The problem is your examiner won't ask for all three. She'll give you a story and say, how would you test the controls in the story? And that makes it a bit harder. And whenever you see the word control in a requirement on F8, put your hand over the question, stop for a second, remind yourself, objectives, procedures, tests, and then go back and read it very carefully and make sure you know which one you are being asked for. As long as you do that and you understand the difference between the three, we should be fine. Now those are probably the two most important things that we've gone through so far, but we have seen a third other area that has an element of practical to it, which was ethics. And in particular with ethics, threats to an auditor's objectivity or independence, as the examiner likes to use those two words as if they are the same, and the safeguards which auditors put in place to manage those threats. Now, I don't think this is desperately difficult, but one important thing is not only that you can understand what types of threat exist and be able to spot what examples are in the story, but perhaps if this comes up in a long question, be able to explain them as well. So, those threats, there are 6 types, which come out as SAFIM, and that's self-interest, self-review, advocacy, familiarity, intimidation, and the management threat. And if you are asked maybe in multiple choice questions to identify which types of threat are in there, you do need to understand how these things work. The self-interest threat is the threat that the auditor ignores financial statement errors for their own gain. Now that could be because they've been given gifts by the client and they want to make sure they get other gifts in the future. It could be because they have a financial interest in the company, like they're a shareholder and they don't want the value of their shares to go down. Could be all sorts of things. The self-review threat is the danger that the auditor ignores or misses, just doesn't even see them, financial statement errors, because they are checking the results of their own work. Now that, remember, can be direct or indirect. If you have actually prepared the accounts for the client and then you check them, well, you're clearly checking your own work. But it can be a little more subtle than that. If you have advised the client on which accounting software to use, or advised them on which finance staff to recruit, or you've helped them with their internal controls over the financial reporting, then you have helped design the process or the staff operating that process that creates the accounts. So when you audit the accounts, you are auditing the results from a process in which you have been involved. Same problem. The advocacy threat is one of the harder ones to understand and explain, because this is where the auditor is seen as on the client's side, so shareholders may assume that financial statement errors have simply been ignored. So this is where you as auditor are doing something with your client that makes it look like you support them, you're on their side. So if you stand up in court and represent them, if you go to the tax office with them to help them reduce their tax bill, you go to the bank to help them get a loan, you're helping them. You seem to be supporting them on their side. Familiarity, fairly straightforward. There's more than one angle to familiarity. I suppose the easiest one is, would you really get your own family, friends in trouble? But there is another angle to it as well, which is when you get too familiar with something, you tend to trust it too much and don't test it enough. You assume it's right when it might in fact be wrong. So I suppose we ought to write that down actually. And too much trust of client is called loss of, quite an important term this, so we'll put it in red, professional skepticism. The intimidation threat is where the auditor feels pressured by the client to ignore mistakes. And notice as I'm going through these that all the explanations are quite similar, aren't they? The danger is there are still mistakes in the accounts that the auditor has either ignored or didn't miss because of some threat to their independence. And the management threat is where the auditor is making decisions for the client instead of the directors making them. So to the outside observer, like a shareholder for example, there is the danger that someone looks at this and thinks you are the directors. And it's very important for auditors in a general sense to be seen as separate from the people whose financial statements they are checking. Okay, so those are the threats to independence. The safeguards are anything you do to reduce those threats. So if anyone is too familiar with a client, take them off the audit team. If you've got people who own shares in a client, take them off the audit team. Or get them to sell the shares, I suppose. If you are asked to prepare the accounts and audit them, probably best you don't do both. But I suppose if you had one group of staff preparing the accounts and a totally different group, then auditing them, it might reduce the problem enough. Okay, well those are the three big topics we've covered so far. There's plenty of other things as well. Since we're at 5 minutes from the end of this, and the only questions I can see so far involve whether the sound is working, which I think it is, over to you guys. A couple of other things I can easily go through, but any questions so far? Anything you don't quite understand, not too sure about? Feel free to ask. I think the session is being recorded, by the way. So it should be posted up. Well, it's Friday today, so it probably won't go up until Monday. But yes, I'm pretty sure it is being recorded. Although I suppose if Mo can't hear anything, I should write, Mo, yes, it is. And maybe that helps, because maybe Mo's lip reading skills with me down in the bottom corner of the screen are not quite as good as they otherwise would be. Okay, well, if anyone wants to ask a question, please do. But in the absence of that, let's look at something else that we have covered so far as well. Let's have a little look at some corporate governance. Now, corporate governance, remember, is about the running of companies in the best interests of the shareholders who own them. Auditing is one part of corporate governance, but there's a whole lot else as well. I like to think of corporate governance as being about four basic things. The UK Code of Corporate Governance is actually in 5 sections, but 2 of them are about the board of directors. Another part of corporate governance looks at director pay, and a 4th part looks at communication between the board and the shareholders. But the one of most importance to us on this course would be financial reporting, internal control systems, risk management, and audit, including, of course, the audit committee. So don't forget corporate governance, focus mostly on the audit committee, but as you can see, there are a few other bits in there as well. But we have got a question, and questions must take priority. What key accounting standards do we need to study for audit and assurance? What a wonderful question. We are, after all, auditing the accounts, so how much of the accounts are we meant to know? You need to know the following. You do not need to know the accounting standard numbers, by the way. I just put those in for your convenience. IAS 1, the most important thing in there is the fact that if there is a going concern threat at a company, they must disclose and describe this threat in a note to the financial statements. IAS 2 says inventory should be valued at the lower of cost or net realizable value. Number 10 is relevant to this course, which is events after the reporting period, the things that happen after the accounting year end, some of which are adjusting, if they are relevant, to the company's year-end position. If they are non-adjusting but material, then they need a disclosure note in the financial statements. IAS 16, which is property, plant, equipment. Nice and easy, this one. Obviously, assets get depreciated. You are allowed to revalue them. So make sure you know what happens with revaluation, the surplus to a separate revaluation reserve, and things like that. 17, 18, 19, 20, 21, 22, 23, 24. The next one of interest on this course is probably 37. Provisions required to be put in accounts if there is a year-end obligation that exists and a payment is likely and can be estimated. If you can't work out the number, you couldn't do it. And contingent liabilities if, year-end obligation, but the payment is possible rather than being likely. The point here is a provision is an actual liability, so debits, credits, and a contingent liability, no debit or credit, just a disclosure note. IAS 38, intangible assets. But the only one she ever seems to do is development costs on F8. And remember that they are capitalised only if the development project is expected to be completed at some point and the product is expected to sell. I think 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's pretty much it, I think, for F8. There are some others which aren't strictly speaking on, but it's helpful to know. So foreign currency, you obviously can't have dollars and pounds in the same set of accounts. They have to be retranslated. And that's useful to know because it creates audit risk with companies who trade overseas. You probably don't want to hear the words financial instruments, but be aware that any financial instrument like loans or issuing shares have a lot of disclosure requirements. You don't need to know what the disclosure requirements are, just that there are lots of them. That's about it, really. So nothing too bad in there, I think. Of all of those, I would say IAS 37 and IAS 10 are two that you want to have a little think about and just make sure you've got your head around them. Okay, good question, and thank you for asking. I don't think I've mentioned that during the course so far. I normally mention it later on when we do substantive testing, but very sensible question. Okay, well, my friends, these half hours go very quickly, but we've done well there. We've covered 3 important parts of the course and the key technique and understanding that you need. And we've dealt with the accounting knowledge as well, which is all good stuff. But that brings us to an end of the first half of this course, including that half-an-hour review, which means it is time for me to say adieu and au revoir. And I will see you again in 3 days' time, Monday night, for class number 5. Until then, thank you all for your time. Enjoy your weekend, and I'll see you again soon. Bye-bye. Au revoir.